So the fees are already being charged today and the revenue's coming in. So Euler's already generating more revenue than Morpho today. It's
Mm,
probably on track to generate several $1 million, I think, over the
mm,
course of a year. One of the big markets on Euler was built by the Usual team, and Euler was the only place in town that they could build this Usual stability loan that they've got. Right, they couldn't build it
mm.
anywhere else, and so they built it on Euler using some of the more advanced, features that the Euler Vault kit provides.
Today is April 15th, 5 p.m. Hong Kong time. Bidcast is being live streamed to BidClub members. Questions are from members and my own. Welcome to another episode of Bidcast. Today we're speaking with Michael, the founder of Euler Protocol. Michael, welcome.
Thank you very much for having me on. Yeah, it's great to be here.
Yeah. I mean, after all the crap that was thrown at you, I mean, you guys are up to $1 billion TVL now.
Yeah.
Why don't you tell us about like why, how did you came from a debt from hacked and then now to $1 billion? What drove that growth? Tell us a bit more about that.
I mean, yeah, it's been incredible. Like I'm just absolutely delighted that we've been able to pull it back like this. We had high expectations, but maybe not this high, for
Mm,
this quick. I think there's been a lot of different factors, honestly. Firstly, we'll get into probably at some point what we've built, right? I think it's fundamentally extremely good technology that's superior to competing technology in a variety of ways, but technology alone isn't good enough. Sometimes you can build a 10 or 20% better product, and if you don't have everything else in place, then that's not enough to overcome competition, right? I think like particularly liquidity is king in these markets for a lot of different protocols, and so even if you've got a 20% better product, if somebody else has got the liquidity and you don't, then they
mm,
can't use your 20% better product, right? So overcoming that challenge has been tough. I think Euler's model naturally lends itself to kind of growing liquidity because it uses this curator model, which is similar to some of the competition, right? Where rather than just have the Euler DAO or Euler DAO associates build a lending protocol, we have different risk curators that come in and build their own products in their own image. And they bring with them their own networks and their own contacts and their own reasons for growing these markets, many of which we're totally unaware of, right? So like some
mm,
people ask me, why is it growing so well on XYZ network, or why is this market so big? And sometimes we just have no idea. I mean, the
mm.
resolve market, for instance, was one big driver in the early days. It's sort of slowed a little bit recently, but still doing quite well on Euler. But that was one market that went extremely well. It was curated by a team called Apostro. They knew the Resolve team. They knew the fundamentals of that project, that they seemed very strong. Honestly, they knew a lot more about it than we did, and that market really, really grew quite quickly on Euler. So that's just one
And then
example, one really nice example of something that took off, and then that's not because of us in a way. We built the technology and facilitated it, but we didn't directly have a massive hand in it. I would say it's all down to Resolve themselves and Apostro for knowing that team and bringing it on board.
and you would say that most of the TVL is just happen organically, like you didn't do BD or anything.
Well, I mean, we have one BD person at Euler who works extremely hard, who knows everybody. He goes around and talks. So I wouldn't say we don't. It's not like we don't do BD, but yeah, a lot of projects. I'm sure everybody knows that a lot of projects start by going out. They have maybe don't even have a live token yet, and they'll secure, some kind of headline figure TVL, which then comes in through some kind of private deal. And Euler hasn't had the liberty of doing that, right? Because we had a liquid token after everything that happened, and I think at the time we relaunched the fully diluted valuation of that was pretty much on the floor. So
Yeah,
it's not like we had the option to go out and offer somebody silly money to go out and bring TVL.
yeah,
So in the end, yeah, we did some. Another driver was we decided to say, well, there are people who still believe in Euler. There's a lot of uncertainty around the project. Can we pull it back? So we decided to do a locked Euler reward campaign, and that has been a big driver. So that uses public incentives, where we essentially
mm,
sort of wrap the Euler token up into a linearly vesting wrapper, and then we distribute that. So I think that's been an important driver, especially to help new markets where there's a bit of a chicken and egg, uh, you know, problem emerge
Mm.
and grow spontaneously. If you look
Yeah,
at the dollar value of the public incentives we've done, it's still less than 3 million
it's not
after
that much. It's not
since
that
launch.
much.
Yeah, yeah,
And so most of the teams that onboarded you through the curation model, they basically thought, oh, we need to create the market here, and this is just about the only solution with V2 that allows us to build or do what we want to do, and that's why we're building. Is that roughly the right line of idea?
I think so. Yeah, I mean,
Mm.
you can't just add any old asset to something like an RV, an established lending and borrowing market, right? It's tricky, but a lot of new assets out there do need utility in lending borrowing facilities.
Mm.
So the other option is to kind of go with an isolated model. That's been tried many times. It's partially the way that things work on things like Morpho,
Yep.
but it's often inefficient. And on Euler, the protocol itself is just way more flexible than any other protocol out there. So you can build more efficient capital markets on Euler than you can elsewhere. And so
Mm.
oftentimes that's one of the main reasons why people come to Euler, is that there's just things they can do on Euler that they can't do elsewhere.
Mm.
And that's yeah. So a lot of these new assets, been a massive proliferation in, stable coins recently and things like that are seeking credit markets to help
Mm.
themselves grow, and so they come to Euler to build. Yeah,
Um, at least as far as I understood it, the the mechanism of V2 and your coding and design mainly benefited your collateral and lending in two ways. One of which is that your liquidation mechanism is a bit more advanced, which
yeah,
allows you to push um, the collateral requirement to be lower than your competition. And the other one is that because of this, hybrid model that you offered, um, uh, the folks that deposit the assets are able to accrue slightly higher yield versus an isolated model, for example. Um,
yeah,
um, is there any way you can quantify for us, like, well, first of all, am I missing anything aside from
yeah.
those two things? And then secondly, can you quantify for us what does that really mean for, let's say, $100 deposited into your platform? How would it translate to like some more additional yield or additional benefits to the depositor or borrower?
Yeah, yeah, sure. I'd say they probably are the two key sort of capital efficiency drivers.
Mm.
And one of the things, just to say up front, what that means is when you're more capital efficient is you don't have to spend and heavily bootstrap like others have done. Yes, but others have had to spend tens of millions of dollars in incentives to grow these markets. But if you have natural drivers of efficiency, then you can grow faster organically.
Mm.
So let's take the liquidation model first. I mean, borrowers on lending protocols sometimes get liquidated, and on other markets they typically pay essentially a penalty on their collateral when they get liquidated. That penalty essentially provides the incentive for the liquidator to provide the liquidation service to perform the liquidation. If you have a very big penalty, then there's a very big incentive. If you have a small penalty, then there's a smaller incentive. But the penalty is always a percentage of the collateral, and so actually that doesn't really make sense, right? If I'm liquidating $100 million position, then a 5% penalty could be absolutely enormous, both for the liquidated party, but also for the person. The incentive is just massive. $5 million for liquidating this position is just way more than any bot runner needs. These are all just bots running these liquidations, right? So why do we need a 5 million penalty? It's insane. But 5% on $100 position, we're now talking $5. Is that even enough to pay the gas cost of liquidation? Possibly not, right? So the point is that the percentage penalties don't really make sense. What there is like a fixed cost of liquidation, and then after that there should be a kind of auction that runs to determine how much incentive you need to liquidate somebody, and that's essentially what Euler does. It has this Dutch auction that's based on something called the health score of a borrower. And what it means is that large borrowers get liquidated at very low percentage penalties. I posted about this on Twitter recently. Some of I think off the top of my head, I think the penalty is way less than 0.5% if if you're borrowing tens of thousands of dollars, which is at least an order of magnitude better than if you get liquidated on something like Morpho or Aave. In some cases, we were 2 orders of magnitude lower on the penalties charged. You know, if you're borrowing millions of dollars, then you definitely want to get liquidated. If you are going to get liquidated, you'd much better off getting liquidated on Euler than on other platforms.
Yep.
So just better for borrowers, I would say, in that regard. But it also means things are better for lenders as well, by the way. You know, people often miss this. If you're taking someone's collateral and taking it out of the system to the MEV bots that run these liquidations, that means they're less collateralized than they were before, which means you push the system closer towards insolvency than it previously was, right? So it's not just better for borrowers. Good, efficient liquidations are better for everybody in the system. And Euler has, in my opinion, the best in the business. I've posted about this many times.
Yeah, and since that is the case, are you able to push the leverage that a borrower can undertake so they have higher efficiency?
I think so. I mean, we often get asked about this. Most of Euler's markets are relatively conservative on LTVs.
Okay.
I would say, and I'll explain why that is in a second as well when we come to the next point you raise. I think if you were to run isolated markets like they have on Morpho or Fluid, you could really push those LTVs much higher. But we tend not to have too many isolated markets on Euler, even though it's possible to create them. Euler is very flexible in that regard. You can replicate Morpho or Fluid type markets on Euler very easily, but most curators tend not to build those markets. And the reason for that actually leads into the next point, which is why are things more efficient in terms of the collateral usage on Euler? It's because on Euler you can essentially, our primitive unit is a single vault, and a single vault can be either used for lending and borrowing, or it can be used as collateral, or both. And so when you use it as both and you have effectively rehypothecation on the markets, that means you're earning interest whilst you're using something as collateral at the same time. That's exactly how things work on Aave. You deposit ETH in Aave to borrow USDC, possibly to go long ETH. God forbid anyone does that anymore. You will often earn interest on the ETH you've deposited from somebody else who's actually borrowing that ETH, possibly to go long on liquid staking token yield or whatever else, right? So that makes the cost of borrowing lower for you going long ETH on something like Aave than it does on something like Morpho. If you were to go long ETH versus USDC on Morpho, your ETH would be just locked in, earning no yield. It would essentially be what's called escrowed and held in a vault, not earning anything. But on Euler and on Aave, the collateral often earns users extra yield, and so that extra yield makes the whole system more efficient. It means that there's you don't have to grow a market like an ETH long position. You don't have to subsidize it as heavily with rewards. You know, I was looking recently and there's nobody going long ETH on Morpho on mainnet, for example. I think there are markets on base like that, but there just isn't on mainnet. And I think it's because it would be very expensive to bootstrap a market like that, perhaps. Or it's just a very different value proposition than it is on Aave or on many of the markets on Euler. So rehypothecation is obviously comes with additional risk as well. I should emphasize that it's not a free lunch by any stretch, but in many cases, a lot of markets, it does make sense to have a degree of rehypothecation, and many curators want that. And then those markets tend to grow faster, and liquidity tends to be stickier in those markets because the capital is just used more efficiently.
And the yield generated on a collateral is certainly higher than a Morpho, but is most of the time not higher than that of Aave, assuming similar level of utilization for borrowing.
On Euler, it tends to be a little higher than Aave at the moment. I think Aave is, I mean, it depends on the market conditions. I would say, frankly, Aave is kind of underutilized at the moment. You know, there's the market's gone more risk off. You've seen that interest rates on Aave have dropped below, you know, on dollars, they've dropped below like even the T-bill yield, which is kind of insane that you earn less on Aave than on T-bills. So it depends heavily, but there's no reason why they should be any less. The yield should be any less on Euler markets than it should on Aave. It really depends how the vault curators configured their markets. Some opt for more conservative parameters, some opt for more risk-on parameters, and which give higher yields. So as always, there's no risk without reward, and it's up to the vault curators and then the people who use those markets to determine. You know, that it's up to the market essentially to determine what people want. It's not a it's not a constraint of the technology in Euler like it perhaps is on other on other products.
Mm,
It's a constraint imposed by the risk curator and then by the market itself on what it wants.
mm. So for anybody who's like borrowing, for instance, it would seem like their collateral would earn well, um, they earn a higher yield than collateral at the moment, uh, thanks to high realization because Aave, given its sheer size, is potentially underutilized. And then their liquidation, they will feel a little safer in cases of like extreme market conditions. And that plus the flexibility that is offered to curators is what you would say basically helps you get from standing start to a billion today.
I think so. I mean,
Mm,
and that and the ability to heavily customize the markets. You can just build things on Euler that can't be built elsewhere because of the underlying flexibility of the technology. So we built in this, we say with a modular lending protocol because what we did was we abstracted all the core properties of lending markets into discrete modules, which then the curators themselves can compose and build back together markets in their image. If you look at Aave, it's a very opinionated product, but on the more complex, more capital efficient side of things. If you look at Morpho, it's kind of on the other extreme. It's very opinionated, but it's on the simplicity side of things.
mm,
Euler is neither, right? It allows you to build either simple markets or more complex ones, and there are just all sorts of more advanced features that you can add. There are like advanced access controls for risk curators to play with if they want more security or risk management control. There
mm,
are hooks for compliance and like trade changing the way that markets work. So one of the big markets on Euler was built by the usual team, and Euler was the only place in town that they could build this usual stability loan that they've got. Right, they couldn't build it
mm,
anywhere else, and so they built it on Euler using some of the more advanced, features that the Euler Vault kit provides them that they can't get on other protocols.
yeah. Um, there's about 30 billion of TVL in Aave, and then maybe 5 billion on Morpho. You're at a billion, and compound for Robert is pretty checked out building Superstate. So like,
Yeah.
there's maybe like 40 billion up for grabs. Um, how do you get from 1 billion to 5 billion? Like, what are you building and what are you working on to get you there?
I think so. There's a few things coming down the line. I mean, firstly, I think it's important to go to where users are, and there are different types of users across DeFi, different networks. Euler's been moving across chain quite rapidly to different networks and meeting users where they are, and that helps for multiple reasons, not just because there's TVL on those networks, but it means that a user that possibly uses one or two of those networks gets more familiar with Euler across those. So you might pick up a user that really enjoys using Euler on base, for instance, and that's also a user of mainnet. And so they might not have found you on mainnet. They might have been an Aave user on mainnet, but they find you on base and now decide to, so you pick up loyal customers and sticky TVL that way, I think. So it's important to go across network, and we're launching on BNB today, in
Hmm,
fact, but we've had
nice.
several other big chain launches over the past few months. So that's one part of things. I think consistent growth and just Lindy is really important.
Mm,
There's nothing better than just proving over time
mm,
that things are secure. I mean, obviously, Euler's like perhaps the most audited protocol in DeFi or close. It's right up there at least. And but yeah, nothing beats Lindy being live. I think Aave proves that, right? It's Aave V3's been around for a long time. It's had
mm,
its own issues in the past, but it's now been robust for quite a long time, I would say, and so people trust it for that reason. So just being secure and safe over a long period of time is really important. You see, you mentioned Compound. They've kind of been checked out. I think there's some efforts to recover their growth from the DAO, from within the DAO, I think, but they've probably been lacking leadership for some time. But their TVL is quite high because ultimately it's an old protocol at this point, and it has that Lindy and it has that trust, I think.
mm.
Um, and then the other thing I would say is, it's no secret that Euler's been building a DEX for some time,
Yep.
and so we're excited to launch that in the near future.
Mm.
That's actually going into audit at the moment. So yeah, it's
Oh,
already
okay.
had already had several really good audits come back, and yeah, we'll hopefully have an announcement out about that in the very near future. And I think
Mm,
that's important because it the way that the DEX works will naturally drive more volume through the Euler lending market. It's not some separate product. You know, people ask why have we built this thing? It's not disconnected from Euler at all. It's in fact heavily dependent on it and a core part of the main Euler lending protocol.
mm.
And that will increase capital efficiency even further. So yeah.
We'll be sure to talk about it, but it seems like it's more so about going on different chains at the moment and let the long tail enablement do its own work. But you're not like actively sort of introducing incentives or is that fair to say?
It's not that we don't do incentives. I mean, we definitely do every new chain deployment. We typically do $100,000 of Euler incentives in this reward all token as a minimum, and then I think the incentives tend to be quite dynamic. So we see what works, what doesn't, what assets come on board. Sometimes there's incentive matching. It depends on what kind of proposals come through the DAO.
Mm,
So they definitely are part of it. It's not like we don't do incentives. Yeah, a lot of people come to Euler for those. Um,
mm,
yeah, I think new networks is quite an important part of it. I mean, there aren't that. I'm not a person that thinks that Euler should be on 100 networks or anything daft. I think there are probably going to be a handful.
mm.
That succeed over the next few years. I think we've had this big proliferation, and now we will probably consolidate on networks that can specialize and offer users something a unique experience. So it's hard to predict ahead of time which those networks will be, in my opinion. There are lots of
Mm.
great builders out there, and it won't necessarily be the best builders that end up winning, of course. So it's really hard to say, but I think yeah, it's important that Euler's on those early. I think if you try to grow somewhere a bit later, it's often much harder than it is if
Yeah.
you're kind of a first mover on those networks. So yeah, that's
Mm.
definitely a key part of things.
So being on all chains like BSC and Base, and then there are more L2s launching. Like, would you be compatible with the faster ones like Monad and Mega Eve and those higher throughput ones eventually?
Yeah, absolutely. Yeah,
Okay.
I mean, I
Mm.
expect the DeFi ecosystems there will be a little different, I suspect, because of the things you can do once you have that. Once the latencies, change by orders of magnitude, that kind of
Mm.
changes the way that things like MEV work and so on. So I think there will be differences, but it shouldn't affect the value proposition of overcollateralized lending and borrowing,
Yeah.
in my opinion. I think
And,
it's
and
more
just to
more likely to
understand,
impact indexes. Yeah,
yeah, 'cause we're going to talk about like the majors for a second because I'll be pretty curious on how you incentivize the TVL there to grow. But it would
yeah,
seem like you really narrow into a niche, which is none of the new launches of new tokens would get on Aave because it's a common pool. So if those collateral rug, everybody kind of there gets hurt. So it's a very rigorous process. But at the same time, it doesn't seem like Morpho is flexible enough. It doesn't offer yield and collateral, and it doesn't it's this almost curated process. So even opening a pool there takes a bit of effort, and the tech there may not support this kind of flexibility. So you're kind of the only game in town when a new protocol that's kind of long tail needs to offer bar lending markets. And is that the right? And that's why you're gaining share so rapidly. Is that the right way to think about it? Because you
I
sort of
think
hit on a
yeah.
market. Yeah, yeah. I
I,
wonder
I,
where else they could go.
Yeah, I think that's partly true. I mean, some of the Oilers' biggest markets are in majors, though. It's not like it's just a sea of sort of long tail projects. I would say there's
Mm,
actually more long tail markets on Morpho, perhaps,
mm,
than there is on Euler. So Euler has a kind of often when people curate the a market, they recreate something that's a bit like an Aave, and inevitably that tends to consist of major type assets.
mm,
So yeah, we have two DAO control markets that are governed by Gauntlet and Objective, two risk curators on Euler, and they're governed by the DAO, much like Aave has its model with Chaos and Llama Risk and others. And yeah, they're very much consist of majors, sort of premium tier,
Mm,
blue chip assets, I would say. So yeah, it's not just long tail. I would say there's yeah, like probably less long tail, really long tail than there is on
mm,
Morpho, where they have these ungoverned. Ultimately, most curators on Euler tend to retain governance control. On Morpho, there's obviously the lower level markets. The Morpho blue markets are all ungoverned. They're sort of permissionless,
mm.
and that brings with it its own unique risks and reputational risks. When people build and curate markets in Euler, they have the option to deploy those ungoverned, isolated pairs, but most of them prefer to, it seems to us, prefer to create their own governed markets where they have greater control, access controls, and ability to, for instance, pause a market or take action in the event that the interest rate model needs changing or the economic environment shifts and so on. And so when you govern markets, you tend to, I think those curators tend to take on board more reputational
Yeah.
challenges, right? And so they don't
Mm,
necessarily want to go out and just deploy markets for absolutely anything. And so the really long tail stuff, I think, is still yeah, not really on Euler,
mm.
I would say.
Do you have any plans to incentivize the liquidity on majors like BTC and all the other major coins, or is that not a priority?
Yeah, no, we have done that. I mean, on Euler Prime, which is the kind of DAO governed market I mentioned, there's incentives on liquidity there on things like on some of the major Bitcoin wrappers,
Mm,
CBBTC. We've done CBE, USDC, Tether incentives, and so on. So some of the majors have definitely been incentivized on that kind of Euler Prime based market and on other networks as well. We've got a big DAO governed market on Base, for example. Yeah, the thing I would say is that incentives, if you're a shiny new project and you've got some low float, high FDV coin to distribute, you can kind of incentivize USDC markets. You can maybe grow 100 million USDC market just by distributing tokens, but Euler hasn't had that. So
mm,
if it can't, like, there's only so much you can incentivize $100 million USDC market or $200 million market, right? If you want to boost the APY by 5%, let's say, and you want to get a $200 million market, you're looking at $10 million in incentives alone. Well, that's three times the total amount of incentives, more than three times the total amount of incentives we've done in, however long, seven months now, whatever it's been, across every single network, across every single market, right? So it just wouldn't be sustainable for Euler to grow massive markets
yeah.
alone using incentives alone. It's just not feasible. But what we do is find that it's successful using incentives in the first few months of a new market.
Mm,
Um, when a market is born, people need a reason to deposit. If there's no depositors, people can't borrow, and so on. So you can actually, yeah, I think, incentivize deposits of USDC up to maybe a 5 or 10 million, or maybe even 20 million sort of size, just using incentives alone. And then
hmm
that gives the opportunity, the kind of seeds the market, gives the opportunity to grow organically from there. If it
mm.
can't find a reason to grow organically from that 10, $20 million starting point by itself, then is it really worth bootstrapping and paying for anyway? I would say probably not. There might be some cases where it needs to get bigger before it's more useful, but yeah, that's generally the philosophy, I think, for us and our strategy for growing things with incentives.
Okay, so that's not the major plan at the moment.
We couldn't
Okay.
even do it if we wanted to. Yeah, so
Yeah.
no.
Okay.
I
And
mean, yeah.
just off the math, usually it's a spread model. Like you clip a fee and the sort of borrow and lending that occurs, especially on the borrowing, and then there's a tick rate. Um, on a billion TVL, is it roughly $3,000 to $4,000 a day and roughly like $1 million a year of revenue to the protocol? Is that roughly right?
I think it's a little higher.
Mm,
It depends on the fees. So yeah, the way that the fees are set on Euler is essentially the curator chooses the fee. Whatever fee they choose,
mm,
the protocol gets half. So they set a 10% fee, 5% of that will go to half of it will go to the curator, half of it will come back to the protocol.
Mm.
Some curators set higher fees on some of the markets. So that I've seen fees as high as 15 or 20% on some markets. So
Mm-hmm.
obviously I'll will get 10% there, and it depends what the interest rates are. So some of the interest rates are way higher than a 5%, right? When
Yeah.
Athena was yielding crazy amounts, it was much higher. So yeah, I think what we've seen is it's probably closer to 2.5 million revenue across the billion TVL,
Currently.
um,
Okay.
annualized, yeah. And
Mm.
um, and then the thing to say as well is that on the Euler DAO governed markets, which are
Mm-hmm.
some of the biggest markets on Euler, there's obviously there's no
Nothing.
curator to pay there.
Mm.
However, much like Morpho, which is obviously has a fee switch turned off at the moment, they would take 10% on all their markets if they turn their fee switch on.
Yeah.
Our strategy essentially was to turn the fee switch on for anything that's long tail, just by default. So the fees were already being charged today, and the revenue's coming in. So Euler's already generating more revenue than Morpho today. It's
Mm.
probably on track to generate several $1 million, I think, over the course of a year.
Mm.
Um, already, but it's switched off for the majors, and that's because just like Morpho, we're trying to grow, and it makes sense to subsidize the growth. You could
Mm.
either do that with token incentives, which we've
Mm-hmm.
discussed are very hard for Euler to do, but rather than do it with incentives, then you just say, well, we'll take no fee on USDC or Tether or WETH or Wrap Bitcoin or CBBTC. So
Yeah.
some of the majors are just completely switched off to kind of incentivize growth.
And that fee is auctioned, and you can bet on those fees based on with Euler, and that's how and then sort of Euler that gets bid sort of get burned. I'm guessing that's how you sort of execute it. Okay, makes sense.
Yeah, they exactly. So fees, no matter what currency they would get bought in on, are kind of
Mm.
auctioned off using this module called fee flow, and the way you bid on the fees is through Euler token. So if
Yep.
someone auctions, let's say if there's a $5,000 auction, then typically around $5,000 of Euler token will be sent in to bid and purchase that. It's
Mm.
obviously there's a little spread there because people want to profit. So yeah, it's a heavily botted auction at this point, I would say, though, and we tend to see it's quite efficient. So
Mm.
yeah.
And how is the team funded at the moment? Like you raise dollars historically. I'm guessing that's still a run rate that you're burning through, and you can sell tokens to fund your operation.
Yeah, it's we have I think we're a runway if we if there's zero revenue, zero sales, anything. Obviously none of that would be true. I think is currently takes us to at least the end of December next
Mm.
year, 2026.
Yeah.
I suspect that might be a little might be pushing into 2027.
Mm-hmm.
And yeah, most of the funding we've raised 3 rounds of funding, right? Historically, our
Mm-hmm.
last funding round was back in 2022. That was led by Horn Ventures. Before that, we had a Series A with Paradigm in 2021, and before that, a seed round with Lemniscap.
Yep. But
Yeah.
sorry, just so I'm aware, like all the fees being generated by Euler protocol gets auctioned and then
Mhm.
directly goes to burn. So allegedly, the equity box should have no revenue going into it.
I see. Yeah, I mean some of the fees don't go into auction. For
Mm.
instance, like the ones on the usual stability loan don't go to auction, so they could be used to fund protocol
Ah.
operations. So it's governed and it depends on the individual market. But yeah, most of them currently are the ones that are being generated currently are being used to buy back the token. So in principle, if that were the case forever, in every market, then indeed you would have a model where you bought back the token and then you would effectively sell the tokens in order to fund operations. That's how the DAO would have
Mm.
to operate. So
Yeah.
I don't think there's a free lunch there. You either take the fees and use those directly to fund
Mm.
operations, or you take the fees and then sell tokens to fund operations. I think it's yeah.
Yeah. And roughly of that 2 to 3, how much is directed towards buyback versus going to the equity?
Currently, when you say equity, you mean
I mean, going directly towards paying the team and salaries
paying
and
the team?
whatnot.
Well, at the moment, I think yeah, I think essentially all of it would have to. Like if we assume that it was all just coming, there was no buyback, right? It would, yeah, I think our burn rate means that we would, yeah, we wouldn't be profitable at the moment at the current situation. I think we had a DAO proposal recently that was requesting somewhere between 5 and 7 million for another year of operation. So that's how much we cost. That's inclusive of absolutely everything. So it's the cost of Gauntlet and Objective, all the audits, all the legal, like it's absolutely everything associated with the project.
So
It's
so there's a
probably
treasury. Got it. So there's a treasury basically, and then the $2 to $3 million goes in, but you're requesting 5 to 7 million a year that is going out. So how
exactly,
much
yeah. So the
so how much goes
yeah.
towards the burn exactly?
Well, right now the tokens go when the in the fee flow auction that's happening right now. I
Yeah.
think basically the tokens aren't being burnt; they're just deposited back in the treasury. So the DAO can choose what it wants to do with those tokens. They could be burnt
I see.
if the DAO votes for it. I mean, we could just switch that on and just burn whatever's been accumulated to date
Okay.
if it wanted. Alternatively, there's some alternative views on this, right? I mean, one view is that you would just burn it. Another view is that you can kind of buy back and redistribute. One thing I would say is that when rewards are distributed on Euler through this reward oil contract, a lot of anybody that breaks vesting, they can break vesting at any point and they can claim what's owed to them, what's due to them through vesting at that point. Any
Hmm.
remainder, the term that it's a 6 month term basically, and any remainder that's not claimed is then burnt. So there is some token being burnt at the moment through early claimants essentially. I'm not sure. I think yeah, last I checked, there's about $150,000 have already been burnt through just early claimers, essentially just unlocking. But that's the only real burn that's happening today, unless the DAO votes to burn some of the buybacks that have been brought back in.
Right. So, and just to be very clear, when you say there's $2 to $3 million of revenue from the fees being generated based on the tick rate of the curators, not all of that is burned. In fact, goes into a treasury, which you have claims to, and you do propose DAO proposals so that those fees actually go to you, the company, the equity.
Yeah, to
Okay.
well, not just to us, but to all service providers, right? Yeah, but
Got it. Yes.
yeah. So right now, yeah. So clearly, right now, the project isn't profitable yet.
Okay.
It's not too far away, but like if you just look at the amount out versus the amount in, there's probably still a $2 to $3 million gap there that needs filling. So Euler still needs to grow, and once it grows a bit
Got it.
more, or it cuts costs a little, let's say, then it would become profitable. Maybe it would become profitable if it either doubled TVL, let's say, or was to
Yep.
halve its
Yep.
costs. Yeah.
And it's fair to assume that after you have sort of started breaking even, then the additional fees that come into the treasury will be sort of aggressively burned,
I
or
think
that will be
so. I
burned.
mean,
Okay.
yeah, it's up to the DAO really. I mean, like
Okay.
there's differences of opinions on these things, right? One way
Mm.
is to burn, so you just give. That's one way to give value back to token holders is to just do pure burns. I mean, a lot of the best companies in the world that don't give value to shareholders that way, right? If like Amazon had just been
Yeah.
burning, so buying back and burning Amazon stock years ago, that probably wouldn't be Amazon today, right?
For
So
sure.
they bear
Hmm.
back and grow. So there are opportunities to do that, I would say, with protocols that you don't always have to burn, but certainly that would be on the table and up
Yeah.
to the DAO.
Yeah. Tell me more about Eulerswap and Euler Earn. The timeline on
Yeah.
those things, like what they can do to the protocol in terms of revenue and the product itself.
Yeah. So Eulerswap is a DEX that's built on top of Euler. Um, it's been coming for some time. We've been building it for many years, in fact. But yeah, it's heavily dependent on the base Euler lending protocol working well first and foremost.
Hmm.
And I'd say I don't want to give too much away on this call, but
Hmm.
what it does is it allow people to turn their accounts on Euler. So somebody with an ordinary lending and borrowing account on Euler, it allows them to turn those individual accounts into essentially a discrete AMM. And
Yep.
the AMM itself then allows swapping to take place against the account. And uniquely, this provides a way for people to provide just-in-time liquidity for swaps. And we think the mechanism here essentially allows somebody with, let's say, professional market maker with, let's say, $1 million margin collateral in Euler could facilitate the same depth of liquidity that you would get on, let's say, a $40 to $50 million curve pool or Uniswap pool.
Mm.
So you see remarkable increases in capital efficiency. The other big gain, I would say, is that the way the swap accounts work, they take advantage of the cross-collateralization of Euler markets. On Morpho, things are only pairs. On Fluid, that deal with pairs. On Aave and Euler, we have cross-collateralized markets. That means that USDC pool on Euler that's cross-collateralized, that we have one in a market called Euler Yield, where it's essentially USDC that's cross-collateralized against 10 plus other stablecoin type assets. Essentially, people will be able to build AMMs that function a little bit like, say, a Curve 10 pool or something. If people are familiar with a Curve 3 pool where they connect like USDC, USDT, and DAI, imagine that, but for Curve, 10 pools or whatever, all built on top of the Euler Yield market. So it's there's no DEX out there that's quite like it today. It's extremely novel. I'd say the closest thing is probably Fluid. If people be familiar with the success they've had on Fluid, they came up with this concept where people's collateral and debt could be used to swap liquidity. So, for instance, if you had USDT debt and I had USDT and wanted USDC, I would send the USDT to you, repay your debt, and then I would borrow on your behalf some USDC and send that back to myself.
I see.
And that's how liquidity inside lending markets can operate as just-in-time liquidity for swappers, essentially. And Euler relies on a similar principle there, but it operates in quite a different way, I'd say, overall to Fluid.
I suppose if it operates in similar ways, and because of the TVL there can start generating swap fees effectively. Do you expect most of the volume to come through aggregators, or would you sort of push a lot of effort to the front end and the marketing growth?
100% through aggregators.
Okay.
I think,
Okay.
I mean, we will probably ship a front end for this, but I think it's very hard to compete by providing a bespoke, unique front end experience. A lot of the volumes on swaps generally goes through aggregators these days. So we've been working really closely with a lot of the major solvers and a lot of the big aggregators out there. We've also been working with another large, well-known DEX and collaborating with them on something. So our go-to-market here is dependent on people not even knowing that they're not even knowing that they're routing trades through what we're calling Eulerswap. It will mostly be aggregator flow. And one thing it does is it not only generates fees for the swappers, but it also increases the borrowing demand on markets, and so in some ways drives up the capital efficiency of the underlying lending markets, because the borrow demand will be higher, meaning obviously higher yields for lenders.
Heuristically, on the same bill in TVL, let's assume there's no additional TVL that came through this. Obviously, there's dependency on how active people are swapping through you. Heuristically, how should we think about this effort bringing to the impacting your revenue? I mean, it should be higher, but is there a scale that would make you satisfied?
Honestly, no. I don't know how much other teams think about this, but what we think of as the primary objective is growth and flows. So I'm sort of anti-fee. I think Euler's barely, nowhere close to being even a year old now, and I think
interesting. Okay.
My emphasis would be on growth and flows and user activity. So the main metrics we care about, I would say, is do we have users that really do we have loyal users? Do we have sticky liquidity? Do the vault curators come and make things that are meaningful, or are they just creating markets that are kind of transient? They exist for people to loot for a little bit and then disappear. We don't want any of that. We want the key KPIs here are real users. Once you capture flows and real users, then you can think about revenues later. So it's not the main. I wouldn't say it's the main objective for us is to focus on revenues, but
Mm,
naturally I would expect there will be an increase in revenues if it's successful.
got it.
It's very new, so we don't know, but hopefully it's
Yeah.
successful, and that will naturally lead to growth and revenue growth.
So I guess as opposed to like the 0.1%, 50 bips, 1%, 3% fee of Uniswap, like would it, well, one, it seems like you will not have additional fee on the swaps, right? You will not charge 0.35%. And secondly, is it fair to say that the fees that you charge, like as if Uniswap would charge one, it will be significantly lower in day one?
I would, I mean, ultimately it will be up to the LPs themselves. The people running these swap accounts, what kind of fees they're
Mm,
setting. There won't be
mm,
any post call fee on by default.
I see.
Similar to
That's cool.
Uniswap, similar to Uniswap. So it'll be up to them, and that they will have to find a balance and figure out what works. It's a little bit unknown, frankly, how what swap fee they should set on this because they have a
Mm,
as an LP here. On the one hand, we have much lower capital requirements for LPing than other dexes. Euler swap will be instantly liquid on day one as long as we have a handful of people running swap accounts. It's not like we need to do massive liquidity mining campaigns or anything, or like private deals to
that's cool.
bring in huge amounts of LP capital like you'd see on other
Because they're
dexes.
just TVLs already. Yeah.
Because there's already TVL in Euler that can be
Mm,
used, right? There's liquidity there that can be utilized. Um, but yeah, then it's up to people to kind of balance the costs of running these accounts, and they're not cost free to run. There's all sorts of things like impermanent loss and like borrowing costs and things that they have to factor in, additional risk perhaps on a new protocol and so on.
mm,
So we'll see what they create. I think the Euler DAO should at least should maybe run itself some swap accounts,
mm.
perhaps even at a loss as a kind of loss leader. Um,
Interesting.
to stimulate growth. But yeah,
But I guess,
that's on my view.
yeah, and sorry to cut you off. Basically, on the fees that they set, you would not be taking a part of it. Like, it will be a zero take rate business. And for a while, I guess how it benefits you would just be more TVL, potentially, if people like this, or increased utilization, driving more tick rate through the back end.
Yeah,
Hmm,
exactly. I mean,
hmm,
there will be
hmm.
will be a fee switch, and there'll be more about that. I think when some of the collaborations we've got become apparent, like more to say
Interesting.
about that. But um, but yeah, the fee switch, I would say the initial drivers here. If you imagine, like you said, you said there's no fee on this thing, no fee whatsoever. Then effectively all the money would go to the LPs, right? And then the LPs would be the ones in competition. So how would they better compete? They'd probably try to lower their fees, and as they lower their
Hmm,
fees, that drives more swap volume through them, which then brings more volumes and flow through the lending protocol,
yeah,
which should bring on board more TVL, which in principle then should mean that the benefits of swapping through oil are even higher because it's deeper liquidity, which then
yep.
should mean more swap volume. And so there's a potential here for quite a strong positive feedback loop, I would say, given the capital
Hmm,
efficiency
hmm.
potential gains of capital efficiency. But
And
it's all remains to be seen.
yeah, and what's the timing on this?
Well, it's going into audit. Yeah, as we speak, it's already had a couple of audits. There's been a couple of changes we've had to make, not because of audits, just because of
Hmm,
go-to-market plans, which again will become more
got it.
obvious as we launch. But I'm we're not talking sort of months and months. I think maybe weeks or months,
Okay.
or maybe another month or so.
I think that's as much as I can get from you on
Yeah.
this call. And I guess this will be a pretty market maker heavy effort because any LPs would have to deal with both the IP as well as any swap that occurs. They're effectively being forced to borrow or lend, if I'm not mistaken. So it
Mhm.
seems like a complex formula if you're managing a lot of positions. So I
Yeah.
guess is that right? Is market makers mostly dealing with this? And secondly, I guess the BD effort there is you and your team actively talking to the Wintermutes of the world. Is that fair to say?
Yeah, I think that's fair to
Okay.
say.
Okay.
When does this go live? Like it's live now, isn't it? But yeah, there's I don't know.
Well,
There's
it's
some
only
things that
live to members, And I
Okay.
guess you can pick an embargo time.
I mean, pick an embargo time, maybe give it a couple of days.
Couple
I think we're
days. Okay.
gonna a couple of 17th. I think we'll have
Okay.
an
Okay. We
announcement
could do
there
that.
to make about
We could do that.
a market maker that you might have
Ah.
mentioned.
Okay.
So
Interesting.
yeah, we'll be we will yeah. I mean, as you said, this is not a retail LP product. I wouldn't say this is
Mm,
not for people to come in and not understand what they're doing. It's definitely a
mm,
sophisticated tool, and people will need to understand the risks. And fortunately, they have the ability to adjust the fees right to hopefully factor in these costs. And so there would probably be some experimentation as they work out how much does it cost me on aggregate across all the
yep.
different costs I might face to run these things, and I want to position my fee accordingly. And hopefully that fee still leaves
Yep.
a lot on the table, and then that makes it competitive in the market. If ultimately the costs run too high, then it will have failed as a product, I suppose.
Yeah.
But we're hopeful that won't be the case.
Yeah. Do you have a? I mean, this is the cooler part of the thesis. Um, how would you define success by your end if this worked? Like I guess, is there a benchmark in your mind that you want this protocol to get to? Like, boy, if the swap had worked, and then the sort of the flywheel really started spinning,
Yeah,
uh, like going from 1 billion to X would make me happy.
I think I think if the so just purely on the swap, I think it's about market share. So I'd like to see it doing similar, having a similar impact to Fluid on the market share of DEXs. I
Mm,
mean, hats off to that team because they've done exceptionally well and managed to take market share in a very, very difficult market to take
yeah.
market share from people.
And what would
It's
that mean
been
for the
yeah.
TVL if you get there? Sorry to cut you off.
Yeah, I mean, in purely TVL terms, uh, maybe doubling or tripling the markets on which these accounts run. So that wouldn't be total TVL, I would guess.
Mm,
I'd like, yeah, it's very, very hard for us to say. So we're not trying to
mm,
we're not trying to set the expectations too high on our side until we see it's just such a novel
yeah.
experiment, I suppose. But my guess is it could really have quite a big impact if you turn a
Mm,
single USDC pool into now the main go-to place where people are swapping
swap. It's huge.
and lending and borrowing.
Yeah.
It could be significant, but it could it's unpredictable. It's hard for us to do tests on this thing, so we've had a few people trying to
Mm,
run small tests in production, but until you go live and really see how well it picks up volume, I would say the it's a little more gas expensive than other exchanges, and how important is that these days? I mean, it
mm,
used to be the be all and end all. When we first started
yeah.
building a
Yeah.
DEX, we're like, how do we get swaps down below 100k gas? Because that it's the main competitive edge you would have. These
Mm,
days, I don't know if that's necessarily true, especially as we move more liquidity to L2s. It's less important there. Even on mainnet, gas costs have come down dramatically, and that the gas cost is just a fixed absolute cost on every swap, right? So if that's
mm,
smaller, then the capital efficiency and the fees start to weigh more heavily on the swap volume you get.
mm. Um, are you going to Solana anytime soon?
No,
Sticking with the EVM. Okay. Um,
yeah.
uh, what So we talked about the swap. Is there anything else that really excites you on the horizon in the next 36 months?
So we've got Euler Earn coming, which works a little bit similar to the way that it's essentially like Euler's version of Metamorpho. And I think these kind of models are quite important actually for the way things work. So on for comparison, on Morpho you have individual markets or individual pairs essentially. And then so that means you might have, I think as they do, like 50 or 60 plus different USDC markets where you can borrow USDC. Now,
Mm,
obviously, alone that's very capital efficient, but the key insight, I guess, with Morpho is that you could have, an aggregator that sits above that, and rather than people depositing liquidity individually, each of the 60 markets, they have somebody like a Gauntlet or a Stakehouse or whoever that essentially manages this aggregator or asset management vault at the top, and retail LPs into the asset management vault, and then the asset manager allocates capital to these lower level markets, and that helps reduce the capital inefficiency of pairs. So it's quite important, and I think it also helps. I think it helps the velocity of capital
Mm.
and finding what finding a place where it's needed in a time efficient manner.
Mm.
If you just run the pairs, then technically the free market, if some new market comes up where there's clearly demand to borrow USDC, technically the market should find that, but I think historically we saw that didn't happen. There was a protocol years ago called Kashi that was almost identical to Morpho Blue in many ways. Like it had
Mm.
reactive interest rates and it was permissionless pairs, immutable permissionless pairs, were very, very similar at its core, but it didn't do very well. And that's because there was no capital allocation layer, there was no asset management layer above, on which, where capital could find new opportunities more efficiently. And I think that's why
Mm.
those types of vaults work well. Euler currently doesn't have those, because it's still, we've had a lot of the innovation on more of that base layer, whereas we said instead of pairs we have more capital efficient sort of clusters of markets. But still, there are still obvious opportunities for growth there. So Euler Earn is an asset management layer that sits on top of all the different lower level markets on Euler.
Yeah.
And it works quite similarly to Metamorpho. One of the main innovations, though, is that we've decided to make it more of a free market model. Metamorpho is a little bit protectionist. So if you would, it sort of only allows you to deploy into Morpho vaults. And so the Euler Earn product will allow you to allocate to Euler or, God forbid, Morpho or Maker or whoever.
That's cool.
Really. And
you just get more users on your platform. That's cool.
Exactly, yeah. So we might end up helping some capital go to other competitors, but at the same time, it's a more useful product, and it should be strictly better, because in the worst case scenario, you could just have all the it could exactly match like the asset management, like going into the Morpho vaults. But if there does happen to be a better opportunity today on Euler or Maker, then you could also allocate to that. So yeah.
I might have some interest for you, because I think a lot of these there are these credit card companies or crypto native debit cards that are popping up, and they're accruing TVL. Those TVL are spendable. They just spend the card, and they almost invariably deposit those TVL into, say, Morpho to like earn yield.
Yeah.
Yours seems like a better way to deploy USDC and USDT in that regards.
Yeah.
So we'll touch base on that offline.
Hopefully. Yeah, sounds great.
Any questions from the group? Give it 3 seconds.
Sure.
I don't think so. Michael, thank you so much for your time. This is really helpful.
Yeah, thank you very much. Yeah, it's been great to chat. Happy to answer any more questions offline. People feel free to reach out, get in touch with me if they have any.
Perfect. Thanks, guys.
Great. Thanks.